Imagine this, just picture this nightmare scenario. A business you've poured, everything into your heart, your soul, every spare dollar suddenly faces a huge problem.
Yeah.
Maybe it's a lawsuit from a client or a supplier debt you just can't cover right now, or some other crisis just hits out of the blue.
Yeah.
And all of a sudden, that problem, it isn't just in the business anymore. It's spilling over, right? It's threatening everything else, everything you've built in your personal life, your savings, your house, maybe even your car.
A terrifying thought.
It really is. That fear of losing absolutely all of it because something went sideways with the business. So the big question is, how do you actually build a real solid financial wall, a boundary between your business and your personal life, your personal assets here in the U.S.?
That fear is, it's incredibly common. And honestly, it's rooted in a very real risk. Because without taking specific, deliberate steps, that boundary often just doesn't exist. Or maybe it's much, much flimsier than most business owners even realize.
So your personal wealth is just out there exposed.
It absolutely can be. It can be fair game for business creditors or, plaintiffs in a lawsuit if things go wrong.
And that is the absolute core challenge we are diving into today. We've got this stack of sources that a listener sent over, articles covering, everything from the basics of business liability insurance to guidance on choosing the right business structure from places like the SBA, the IRS.
Good, solid sources.
Yeah, and also some really deep dives into legal insights around LLC protection, the absolute necessity of documents like operating agreements, registered agents, and why keeping business and personal finances separate isn't just like good housekeeping, but actually critical to that legal shield.
It really is. It's a comprehensive look at building that essential financial protection. So our mission today is basically to unpack all these sources, pull out the most important nuggets of wisdom, and really lay out the key steps you need to take to create a genuine shield for your personal wealth. We'll look at how the structure you choose. That's like your first layer of armor, right? Then the crucial legal documents that back that up, the absolutely non-negotiable financial practices you have to follow, and also the pitfalls, the things people often overlook that can leave you dangerously exposed.
Okay, let's dive right in then. To protect yourself, I guess you first have to really get your head around the risk itself. And at the heart of it, like you said, is this idea of personal liability.
Exactly. The sources make this crystal clear right at the beginning. As a business owner, and this really depends on how your business is set up, your personal finances are directly vulnerable if your business faces a lawsuit or racks up huge debts it can't pay or, runs into other serious financial trouble.
So your personal money can get pulled into the business mess.
It absolutely can and often will if that legal separation isn't properly set up and, just as importantly, maintained.
And the sources point out that some business structures, they basically offer zero protection. You're essentially naked in the face of this risk.
That's a really good way to put it, yeah. The sources definitely highlight sole proprietorships and traditional partnerships as the structures facing what's called unlimited personal liability.
Unlimited. That sounds bad.
It is. It means there is no legal distinction, none whatsoever, between you, the individual, and your business. Legally speaking, you are the business.
Wow.
So if the business owes money, you personally owe that money. If the business gets sued and loses, you personally have to pay the judgment.
So we're talking personal savings accounts, the equity in your home, your car, personal investments. All of it is potentially on the line.
All of it. It can all be claimed by business creditors or used to satisfy a lawsuit judgment against the business.
Yeah.
Your entire personal net worth is exposed.
That's sobering. It's the simplest way to start a business, maybe, but it sounds incredibly risky from a personal standpoint.
It is. It offers zero protection for your personal assets. And, the same applies to general partners in a traditional partnership. They also face that unlimited personal liability for all the partnership's debts and obligations.
Oh.
And sometimes that's even if another partner was the one who caused the problem.
Ouch. So you could be liable for someone else's mistake in the partnership.
You could. The business in these structures is really just a legal extension of you.
Okay.
Now, it's important to note, and the sources are clear on this too, that even if you choose a structure specifically designed for protection, like, say, an LLC or a corporation, you, the owner, can still end up personally exposed under certain circumstances.
Ah, so even the shields aren't foolproof.
Exactly. That initial protection isn't always impenetrable, and recognizing when it might fail is absolutely crucial. We'll definitely dig into those exceptions later. But the key takeaway right now is that the default setting for many businesses is just unlimited personal risk. Building that shield takes deliberate action, starting with your choice of structure and then how you actually run the business.
Right. Which brings us perfectly to that foundational decision. Choosing your armor, the business structure itself.
Yeah, this choice is, well, it's arguably the most fundamental step you take when starting out. It affects everything, not just your day-to-day operations or how you pay taxes, but it fundamentally dictates the extent to which your personal assets are legally separated and protected from business liabilities.
So it's about finding the right balance. Legal protection, ease of setup, taxes, maybe raising money later.
Precisely. Finding the right fit for your specific situation and risk tolerance.
Okay, the sources give us a pretty helpful rundown of the common structures here in the US and what they mean for liability. Let's start with the one we just touched on, the absolute simplest, the sole proprietorship.
Right. As we said, this is basically the default. If you just start doing business on your own, you don't usually need any formal state registration beyond maybe some local licenses or permits. It's incredibly easy to set up, and you have complete control.
Sounds good so far.
But, and this is the huge but, the sources hammer home, there is no separate legal business entity created. None. Your business assets and liabilities are legally one and the same as your personal ones.
Which means?
Unlimited personal liability. Any business debt, any lawsuit against the business can directly target your personal wealth, your house, your savings, everything we mentioned before.
And the sources also mention it's hard to raise money this way, like getting investors or big loans.
Exactly. You can't sell stock in a sole proprietorship. And lenders, well, they often see that lack of separation as a much higher risk. It makes borrowing significant amounts harder.
So who is this structure actually good for then?
According to the sources, it's really only recommended for businesses with like very low risk profiles. Or maybe if you're genuinely just testing out a business idea on a really small scale before you commit to forming a more formal entity. For most ongoing ventures, the potential personal financial exposure is just too significant.
Okay, makes sense. Moving up a notch in complexity, we've got partnerships. This is for 2 or more people going into business together.
Right. Partnerships are similar to sole props in how easy they are to form initially, but obviously they involve multiple owners, and there are different flavors of partnerships. A traditional general partnership, well, it operates a lot like a sole proprietorship with multiple owners.
Meaning shared liability.
Yes. All the partners typically share in managing the business and splitting the profits, but they also share in that unlimited personal liability for the partnership's debts and actions. If the partnership gets sued or can't pay its bills, all the general partner's personal assets are potentially at risk.
Even if only one partner messed up.
Often, yes. That's the nature of joint and several liability in many general partnerships. It feels like taking on risk for someone else's actions, like you said earlier.
Yeah, definitely. Are there partnerships with better protection?
There are. The sources mention limited partnerships, or LPs. These structures have at least one general partner who manages the business and has unlimited personal liability, just like before. But they also have one or more limited partners.
And the limited partners are limited how?
Their liability is typically limited to the amount of money they've actually invested in the business. They generally don't face personal liability beyond their investment. However, the trade-off is that limited partners usually have very little or no control over the day-to-day operations. They're more like passive investors.
So in an LP, one person, the general partner, still carries that full personal risk burden, while the others get some protection as long as they stay hands-off.
Correct. And that's a key point. If a limited partner starts getting too involved in management, they can actually lose that limited liability protection.
Oh, okay. Interesting. Any other partnership types mentioned?
Yes, there's also the limited liability partnership, or LLP. This structure is pretty common for professional service firms. Think law firms, accounting firms, architecture practices, that kind of thing.
And the limited liability part applies to everyone.
That's the key difference. An LLP offers limited liability protection to every partner. It protects them not only from the general debts of the partnership, but also, importantly, from malpractice or negligence claims arising from the actions of other partners.
Oh, that's huge for professionals. So an LLP shields you from your partner's screw-ups, whereas a general partnership might not.
Exactly. It provides a really important layer of protection within the partnership structure itself, specifically against vicarious liability for other partners' professional mistakes.
How are partnerships usually taxed?
For most types, general, LP, LLP, the profits and losses typically pass through to the partner's personal tax returns. The partnership itself doesn't pay income tax. This avoids corporate-level taxation. However, general partners, and usually partners in LLPs too, are considered self-employed, so they're responsible for paying self-employment taxes, which cover Social Security and Medicare, on their share of the earnings.
So partnerships seem better suited for multiple owners, maybe testing an idea, or for professional groups needing that interpartner protection like in an LLP.
That's a good summary, based
Yeah.
on the sources, yes.
Okay, now let's get to the structure that seems to be like the most popular choice for small and medium-sized businesses in the US looking for that liability protection. The limited liability company, the LLC.
Yes. The sources definitely spend a good chunk of time on the LLC, and for very good reason. It's often described as a kind of hybrid structure, taking features from partnerships and corporations. Its core benefit, and really the main reason it's so popular, is that it protects you, the owner, from personal liability in most instances.
Okay, tell us more about that shield. How does it work?
So what the source explained is that when you properly form an LLC, you create a separate legal entity. It's distinct from its owners, who are called members in an LLC.
A separate legal person, basically.
Kind of, yeah. And this legal separation is key. It means the LLC itself is responsible for its own debts and its own obligations. Your personal assets, your house, your car, your personal bank accounts, your investments are generally protected. They usually cannot be pursued by business creditors or plaintiffs in a lawsuit against the LLC.
So if the business gets sued or goes bankrupt, they can only go after the business's assets, not my personal stuff.
Generally, yes. Their claim is typically limited to the assets that are actually held by the LLC itself. That's the limited liability promise of the limited liability company.
Puts a wall up.
Exactly. A legal wall between your personal wealth and the business's financial risks. And like partnerships, LLCs typically offer what's called pass-through taxation by default.
Meaning no corporate tax.
Right. The profits and losses flow through to the members' personal tax returns, and the members pay income tax on their share. This avoids that potential double taxation you can get with corporations. Members are generally considered self-employed for tax purposes, similar to partners, and pay self-employment taxes on their share of the profits.
So who is the LLC really good for?
The sources suggest it's a really strong choice for medium or higher risk of businesses, or, frankly, for any business owner who has significant personal assets they want to make sure are kept safe from business liabilities.
Makes sense. Then we have the most formal structure, usually, corporations. The sources mention C Corp and S Corp.
Right. Corporations, often initially formed as C Corp, are also separate legal entities, just like LLCs. But they generally represent the most complex structure in terms of setting them up and the ongoing compliance requirements. However, they also offer the strongest and most time-tested form of protection to the owners, who are called shareholders in a corporation, from personal liability.
Stronger than an LLC. How so?
The legal separation principle is similar, protecting personal assets from business liabilities. The difference isn't necessarily in the strength of the veil itself, if properly maintained, but more in the historical precedent and the often stricter governance requirements that reinforce that separation. A corporation is seen as a completely separate legal person that can enter contracts, incur debt, sue, and be sued, entirely distinct from its owners.
Okay, so maybe more established legal ground plus more formal rules.
Generally, yes. C Corp typically have more extensive regulatory requirements. They usually need formal boards of directors, regular shareholder meetings, and they have to keep detailed records called corporate minutes, which we'll talk more about later.
And the big difference everyone talks about is taxes, right? The C Corp tax.
Yes, that's a major distinction the sources highlight. A standard C corporation is taxed separately from its owners. The corporation itself pays income tax on its profits at the current corporate tax rate.
Yeah.
Then, if the corporation distributes any of those profits that have already been taxed to its shareholders in the form of dividends, those dividends are taxed again on the shareholders' personal income tax returns.
Ah, that's the infamous double taxation.
That's it. The profits get taxed once at the corporate level, and then again when distributed to the owners.
Which could be a pretty big drawback, especially for smaller businesses where the owners want to take the profits out regularly.
It definitely can be. However, the C Corp structure is often the best choice for businesses that plan to raise significant amounts of capital by selling stock to investors, or those with ambitions to eventually go public or be acquired by a larger company. It's the standard structure for larger enterprises.
Okay, but what about the S Corp? The sources mention that too. It's still a corporation, but it avoids the double taxation.
Exactly. That's its primary tax advantage. An S Corp isn't actually a different legal structure you form with the state. Instead, it's a special tax election that an eligible business, which can be either a corporation or sometimes even an LLC, makes with the IRS.
So you form a corporation or LLC first, then tell the IRS you want to be taxed as an S Corp.
Pretty much, yes, assuming you meet the eligibility rules, which can be quite strict. Things like limits on the number and type of shareholders. By making that S Corp election, the business's profits and losses are then passed through directly to the owner's personal income, similar to a partnership or LLC. This avoids the corporate income tax layer on profits.
So potentially the best of both worlds. You get the strong liability protection of corporation, but with the pass-through tax treatment if you qualify.
That's the idea. It's a way to get that robust legal shield without the C Corp double taxation hit. But you definitely have to navigate the specific IRS requirements carefully to qualify and, just as importantly, to maintain that S Corp status over time.
Good point. And the sources also made a distinction I thought was important. State law versus federal tax law.
Yes, that's crucial to understand. State law governs how you actually form and operate your business entity, whether it's an LLC, a C Corp, an S Corp election. It doesn't change the state-level entity type, etc. Federal tax law, mainly from the IRS, dictates how that entity is taxed.
So they're related but separate things.
Exactly. They're governed by different sets of rules. For instance, an LLC is a legal entity type created under state law. But for federal income tax purposes, that same LLC can choose how it wants to be taxed by default. It might be taxed like a sole proprietorship if one member, or a partnership if multiple members, or it can elect to be taxed as an S Corp or even a C Corp.
Wow. Okay, so lots of options, and the structure choice is clearly fundamental. But, the sources were also very clear that just picking a structure like an LLC or a corporation isn't some kind of magic bullet. That shield you think you have, it has limits, right?
This is such a vital point, and honestly one that many business owners miss. They go through the trouble of forming an LLC, pay the fees, and think, okay, I'm safe now. But the sources highlight several specific situations where, even with that protective structure in place, your personal liability can still pop up. That shield can definitely get thin or even disappear altogether.
Okay, we need to know about these exceptions. Where can you still be personally on the hook, even with an LLC or corp?
Well, one of the biggest and most common ones is personal guarantees.
Like signing personally for a business loan.
Exactly. If you personally sign a guarantee for a business loan or maybe a commercial lease agreement or any other kind of business obligation, you are explicitly, contractually agreeing to be personally responsible for that debt if the business can't pay it.
So the LLC or corporate shield just doesn't apply to that specific debt you guaranteed.
Correct. It doesn't protect you from a contract you signed in your personal capacity. You essentially waived the entity's protection for that specific obligation. If the business defaults on that loan, the bank will come after you personally because you promised they could.
Okay, that makes sense. You signed up for that specific risk. What else?
Another critical exception is when you, the individual owner or member, personally commit negligence, fraud, or other wrongful acts that cause harm.
So the business entity doesn't protect you from your own bad behavior.
Precisely. The LLC or corporation protects you from liabilities arising from the legitimate business operations conducted properly. It does not protect you from your own personal illegal actions or harmful behavior, even if it happens while you're technically on the job. So if you personally commit fraud, or if you physically assault someone while representing the business, or perhaps make serious negligent professional errors that fall outside how the business is supposed to operate, you can be held personally liable for the damages caused by those actions.
You can't just hide behind the company name if you do something wrong yourself.
Exactly. The shield protects against the entity's liabilities, not your own personal torts or potential crimes.
Okay. Any other big exceptions mentioned?
The sources also brought up a more specific but potentially incredibly costly example: liability for environmental cleanup.
Environmental cleanup, how does that work?
Well, there are laws, like CERCLE, which is often called the Superfund law. These laws can impose strict liability on property owners, and sometimes operators, for the cost of cleaning up hazardous substances on a property. And this liability can attach regardless of who actually caused the contamination.
Wow, strict liability. So just owning the contaminated land is enough.
In many cases, yes. And the point the
Yeah.
sources make is that simply holding that contaminated property within an LLC might not be enough to shield the LLC members personally from these mandated cleanup costs. Because the laws prioritize environmental protection so highly, courts may look through the LLC to the individuals controlling the property to ensure the cleanup gets paid for.
That's a really specific but potentially devastating exception. It shows that sometimes these big public interest concerns can kind of override the usual limited liability concept.
Absolutely. And when you combine these specific exceptions with actions that just generally blur the lines between you and your business, you get to the most significant overall threat to your legal shield. This legal concept called piercing the corporate veil.
Piercing the corporate veil, yeah. That sounds like exactly what it is, breaking right through that protective wall.
It is. And it's a very real legal risk, not just theoretical. It happens when a court decides that the legal distinction between the business entity, like your LLC or corporation, and its owners has been so poorly maintained, or maybe the entity was used to commit fraud or some kind of injustice, that the court chooses to just disregard the entity's separate legal status entirely.
And if the veil is pierced?
Then the owners are held personally liable for the business's debts and obligations, just as if that LLC or corporation never even existed.
Ouch. So all the effort, all the cost of setting up that separate entity, it just goes completely out the window.
Precisely. The wall comes crashing down, and suddenly your personal house, your savings, everything is exposed to the business's creditors.
What kind of things cause a court to pierce the veil?
Well, the sources list several common reasons. A big one is failing to follow the required corporate formalities. Things like not holding required director or shareholder meetings for a corporation, or not keeping proper records like corporate minutes. Another is using the entity to perpetrate fraud, obviously. And critically, probably the most common one for small businesses is commingling personal and business funds.
Mixing money. We talked about keeping things separate earlier.
Yes. If you consistently treat the business bank account like your personal piggy bank, paying personal bills from it, depositing business income into your personal account, a court is far, far more likely to say, look, you didn't treat this business as separate, so why should we? They'll see it as just an extension of you, not a distinct entity deserving of protection.
Which really underscores that point. Just choosing the right structure isn't nearly enough. You have to consistently act like it's a separate entity in everything you do.
Exactly right. And that means actively bolstering that initial shield with essential legal documents and maintaining ongoing compliance with the rules.
Okay, let's talk about those crucial documents then. For LLCs, the sources put a lot of emphasis on something called the operating agreement.
They do, and rightly so. The operating agreement is basically the foundational legal document for an LLC. You can think of it as the internal rulebook or governing document. It sets out how the LLC is structured, how it's going to be managed, how decisions get made, how profits and losses are shared, and generally how the business will operate day to day.
It's like a contract between the owners, the members.
Exactly. It's essentially a contract among the members of the LLC, outlining their rights and responsibilities.
Now, I know some states don't actually legally require you to have one, right?
That's true.
Yeah.
It's not legally mandated in all 50 states, although the sources do correctly point out that it is required in several key business states, like California, Delaware, New York, Missouri, Maine, Nebraska. But here's the thing. Even in states where it's not officially required by law, the sources are unanimous. Having a well-drafted operating agreement is absolutely crucial for every single LLC. Doesn't matter if it's 1 member or 10 members.
Okay, so why? If the state doesn't force you, why is it still so vital? What are the real benefits?
The benefits listed are pretty compelling. First and foremost, it significantly strengthens your liability protection. How? By clearly defining the LLC as a separate legal entity, and maybe more importantly, by demonstrating that you are operating the business formally and professionally.
It's evidence.
Exactly. It's key evidence. If someone ever tries to argue in court that your LLC is just a sham or your alter ego to avoid personal liability, it helps prevent that piercing of the corporate veil we just talked about. It shows you're respecting the formalities, reducing the risk of being treated like a sole proprietorship in disguise.
So it proves you're taking the separate entity idea seriously. Okay, what else?
Secondly, it enhances clarity and prevents disputes among the members. Think about it. By clearly outlining everyone's roles, their responsibilities, how much they contributed, how decisions get made, how profits and losses are split, what happens if someone wants to leave or, God forbid, passes away, it provides a clear roadmap. It helps resolve potential conflicts before they blow up into expensive legal fights.
Especially important if you have partners, I guess.
Definitely crucial for multi-member LLCs, but honestly, it's also really helpful even for a single-member LLC, just as an organizational tool, and again, as proof of formality.
It almost sounds like a business prenup, in a way, setting the rules up front.
That's actually a pretty good analogy in some respects. It sets the ground rules for the relationship within the LLC. And thirdly, it provides customization.
Customization? How so?
Well, if you don't have an operating agreement, your LLC is governed by the default rules set out in your state's LLC statute. And those default rules might not be what you want. They might not fit your specific business model or the understanding between the members. An operating agreement lets you tailor the rules, how things are managed, how money is distributed, voting rights to your specific needs and agreements.
Okay, so strong liability protection prevents disputes, allows customization. What are the downsides? The sources must mention some reason why people might skip it.
Really, the only cons mentioned are minimal. The
Yeah.
extra expense, because you'll likely want a lawyer to help draft it properly. It may be just the perceived formality or hassle of doing it. But honestly, when you weigh that against the risk of not having one, the increased chance of piercing the veil, messy member disputes, being stuck with state default rules you don't like, the sources overwhelmingly conclude that the investment in a good operating agreement is absolutely worthwhile.
And a few technical points the sources mentioned. It's usually not notarized, right? And you
Yeah.
don't file it with the state like you do the initial formation papers. It's not public.
That's all correct. It's typically an internal, private document kept with the LLC's records. Unlike the articles of organization or certificate of formation, which are filed with the state and are public record, the operating agreement stays private among the members.
And just to reiterate, because the sources stress this, it's important even for a single member LLC.
Absolutely critical, even if you're the only owner. Why? Because it helps solidify that legal separation between you personally and the LLC entity in the eyes of a court or maybe even the IRS. It helps prevent arguments that the LLC should just be disregarded entirely because you didn't treat it as separate, which again would wipe out your personal liability protection.
Got it. What kind of things typically go into an operating agreement? What does it cover?
The sources list a whole range of key provisions, things like details about the members, who they are, their ownership percentages, their initial contributions. How the LLC will be managed by all the members, or will you appoint specific managers? The powers and duties of the members and or managers. How voting works on important decisions, procedures for adding new members down the road, or what happens if a member wants to leave, retires, becomes disabled, or dies. These are often called buy-sell provisions. How profits and losses are allocated and distributed, which, importantly, can sometimes be different from the ownership percentages if you agree. Any requirements for meetings, how the LLC would be dissolved if it came to that, and sometimes specific tax elections or considerations.
Sounds pretty comprehensive. When's the best time to create it?
The sources strongly recommend doing it right when you are forming the LLC. Get the rules in place from day one. The process usually involves understanding your state's LLC laws, gathering all the necessary information about how you want the business to run, and the agreements between members, outlining those key provisions, drafting the actual agreement, often with legal help to make sure it's solid, and then having all the members sign it and keep copies safely stored.
Okay, that covers LLCs. Now, for corporations, the equivalent ongoing documentation isn't an operating agreement, but something called corporate minutes.
Exactly. For corporations, corporate minutes are the formal written records of the decisions made and the actions taken during official meetings of the corporation's board of directors and its shareholders.
And why are these so important? How do they help bolster that liability shield for a corporation?
Well, corporations inherently have stricter legal requirements for governance than LLCs typically do. State laws generally mandate that corporations hold regular meetings, like annual meetings of shareholders and regular meetings of the board of directors. Corporate minutes serve as the official legal record of what happened at those meetings.
So proof that the meetings happened and decisions were made.
Precisely. And just like the operating agreement does for an LLC, these minutes are crucial for legal compliance. They demonstrate that the corporation is operating as a distinct, formal legal entity, following the required procedures, and not just acting as an alter ego of its owners. This becomes vital evidence if anyone ever tries to pierce the corporate veil of the corporation.
So again, it's about showing you're running the business properly, like a real corporation.
Exactly. The benefits they provide are pretty significant. They create a clear, legally recognized record of all major business decisions. Think about things like electing the board of directors and the corporate officers, like CEO, CFO, approving major contracts, authorizing the issuance of company stock, deciding to buy or sell significant assets like real estate, setting executive salaries and compensation plans, approving annual budgets, or making decisions about big strategic moves like mergers or acquisitions.
So it documents the why and how behind the big decisions.
Yes, and that documentation protects the corporation's legal status if disputes arise later, whether it's internal disagreements among shareholders or directors or external lawsuits. They can also be really important for tax purposes, helping to substantiate certain expenses or corporate actions if the IRS ever asks questions. And they provide a valuable historical record of the company's governance and key decisions over time.
It sounds like you need minutes for the important official stuff. Do you need to, write minutes for every casual chat in the hallway or every minor daily operational decision?
No, generally not. The sources clarify this. Corporate minutes are typically required only for those formal, official meetings of the board of directors or the shareholders, where specific corporate actions are voted on and approved. Routine, day-to-day business decisions made by the company's officers or managers in the normal course of business don't usually require formal minutes. The key is documenting the actions taken by the governing bodies, the board, and the shareholders that affect the corporation's legal standing, structure, and major direction.
Okay, so operating agreements for LLCs, corporate minutes for corporations. Got it. What about the registered agent? The sources said this is a requirement across different structures, corporations, LLCs, even some types of partnerships.
Yes, this one is absolutely non-negotiable, and it's mandated by law in all 50 U.S. states. A registered agent, sometimes you'll hear it called a statutory agent or resident agent, depending on the state, is basically an individual or a business entity that you formally appoint to receive legal documents and official government correspondence on behalf of your business.
So they're the official point of contact for legal stuff, like if the business gets sued.
Precisely. That's their primary function, to be a reliable, designated point of contact within the state where your business is registered, specifically to receive what's called service of process.
Service of process, meaning legal papers.
Exactly. Things like lawsuit summons and complaints, court subpoenas, wage garnishment orders, official tax notices from the state, and other critical government communications like annual report reminders or notices about maintaining good standing. The registered agent receives these crucial documents and is legally obligated to forward them promptly to the right people within your business.
Why does every single state require this? What's the logic?
The core reason, as the sources explain it, is really about accountability and ensuring due process in the legal system. For the courts and government agencies to function properly, there has to be a guaranteed way to formally notify a business if it's being sued or needs to receive official communications.
Otherwise, businesses could just hide or claim they never got the notice.
Potentially, yes. Mandating a registered agent with a physical address in the state ensures there's always someone officially designated and available during business hours to accept these important documents on the business's behalf. You actually have to name your registered agent in your initial formation documents when you register your business with the state.
Okay, that makes sense. What happens if you don't have one? Or maybe the one you listed isn't available or valid anymore. What are the risks?
The risks are actually quite significant and can directly undermine your liability protection. If you fail to appoint or maintain a valid registered agent, the state can hit you with administrative fines and penalties. More critically, your business can be deemed non-compliant with state law. This could lead to losing its good standing with the state.
Losing good standing, what does that mean practically?
It can mean you're barred from filing lawsuits in that state, or you might not be able to get certificates needed for loans or contracts. In some cases, it could even lead to administrative dissolution of your company by the state. And perhaps the most immediate danger. If you miss being served with a lawsuit because service couldn't be properly delivered to a valid registered agent, you might never even know you've been sued until a default judgment is entered against your business.
A default judgment, meaning you automatically lose the case because you didn't show up to defend yourself, even if you didn't know about it.
Exactly. You lose without ever getting your day in court. It severely limits your ability to defend your interests. So, losing good standing, facing default judgments, these can cripple a business. It seems like a simple administrative thing, but neglecting it has serious potential consequences, potentially undoing all the other steps you took to build that legal shield.
Wow. Okay, so who can be a registered agent? Are there specific qualifications?
The sources lay out the basic requirements. The agent must have a physical street address. A P.O. box is generally not acceptable located within the state where your business is registered. This is often called the registered office.
A physical address in the state. Got it.
They must also be reliably available at that physical address during normal business hours, which is typically defined as something like 9 a.m. to 5 p.m., Monday through Friday, to accept documents in person.
So they have to be there during a workday.
Yes, and the agent must be either an adult resident of that state, if it's an individual, or a business entity that is authorized to conduct business in that state if you use a professional registered agent service. There usually aren't specific educational or professional license requirements, just that they meet these critical location and availability criteria.
Can I just be my own registered agent, like list myself or my business partner?
Legally, yes, in most states that's permissible. And some small business owners do choose this route, thinking it saves money on paying for a service. However, the sources strongly caution against this practice for several important reasons.
Okay, what are the downsides of being your own agent?
Well, first, if you name yourself, you personally must be consistently available at that designated physical address in the state during all standard business hours. If you travel a lot for work, if you work remotely sometimes, if you have meetings out of the office, or even just take lunch breaks away from that address, you risk missing an important legal delivery service of process.
That sounds impractical for a lot of business owners.
It can be. Second, your registered agent's address becomes public record. It's listed in the state's official business filings, which are often easily searchable online. If you run your business from home and list your home address as the registered agent address, well, now your home address is publicly available information. That's a big privacy concern for many people.
Yeah, I wouldn't want my home address listed publicly like that.
Right. And third, you need to actually understand the responsibilities, recognizing what constitutes official service of process, knowing how critical those documents are, and ensuring they get handled correctly and immediately within your business. Missing a deadline because you didn't realize the importance of a document could be disastrous.
So convenience, privacy, and just making sure it's handled right are the big trade-offs. It sounds like hiring a professional registered agent service might be worth the cost for a lot of people.
Many business owners definitely find that the peace of mind, the guaranteed availability, and the privacy protection are well worth the relatively modest annual fee. Professional registered agent services, or sometimes individual professionals like lawyers or accountants who offer this service, specialize in this role. They ensure someone is always available during business hours, they understand how to handle sensitive legal documents properly, and they use their address, not yours, keeping your personal address private.
How much does that typically cost?
According to the sources, the cost usually ranges somewhere between, say, $100 and maybe $500 per year, depending on the provider and the state. You can find dedicated registered agent companies that just do this, or sometimes law firms or accounting firms offer it as part of a package, though law firms tend to be on the higher end of that cost range. Often, these professional services also provide helpful compliance reminders for things like annual report filings, which can be a nice added benefit.
Okay. And what if you need to change your registered agent later on? Maybe you move states or just want to switch providers?
That's definitely possible. It involves a formal process with the state government. You typically have to file a specific form. It might be called a statement of change of registered agent or a certificate of change or something similar with the Secretary of State's office or the equivalent agency that handles business filings in that state.
Do you need the new agent's permission?
Yes, you usually need to provide the name and address of the new agent and often confirm their consent to serve. You should also formally notify your old agent that you're making the change. And of course, you'll want to update your own internal business records, like your operating agreement or corporate minutes, to reflect the new registered agent information. It's important to follow the state's specific procedures carefully to make sure the change is properly recorded and your business stays in compliance and maintains its good standing. Okay, so we've covered the legal structures, the essential documents like operating agreements and minutes, and the registered agent requirement. But now we get to another piece that the sources identify as just critically important. It's a practical, everyday practice that directly reinforces that legal shield, maybe more than almost anything else you do day to day.
And that is?
Maintaining strict, clear financial separation between your business and your personal finances.
Ah, yes. This isn't just about, like, good bookkeeping for taxes, is it? It's directly tied to protecting that legal wall.
Absolutely, 100%. The sources are incredibly clear on this. They describe the practice of mixing personal and business funds, which has that legal term commingling, as being like a ticking time bomb. They say it can literally destroy the corporate shield.
Wow, strong words.
They are. Because even if you went through all the effort and expense of forming that LLC or corporation, if you then turn around and treat the business bank account like your personal checking account or vice versa, a court is way more likely to pierce that corporate veil if your business ever faces a serious lawsuit or massive debt.
So all that legal paperwork to create the separation could be completely undone just by being sloppy with how you handle the money day to day.
Precisely. Commingling funds blurs those financial lines so much that a court can easily look past the legal entity structure you created and hold you personally liable for the business's problems. It's often one of the strongest pieces of evidence used against a business owner when someone is trying to pierce the veil. The logic is simple. If you didn't treat the business's money as separate from your own, why should the law treat the business as separate from you when it comes to liability?
That's a really powerful warning. Okay, so beyond that huge legal risk of piercing the veil, what are the other practical reasons the sources give for why keeping finances separate is so important?
Oh, there are many, and they all contribute to just running a healthier, more successful business. Firstly, as you touched on, it's absolutely crucial for tax purposes.
Makes taxes easier.
Vastly easier. Separating funds makes tracking business income and expenses incredibly straightforward. This helps you avoid disputes with the IRS or state tax authorities. It also ensures you can maximize all your legitimate business deductions. Think about things like the home office deduction or deducting vehicle expenses. They are much, much easier to justify and far less likely to be disallowed during an audit if your business and personal finances are crystal clear and separate. It ensures proper compliance with tax laws and helps you claim every advantage you're entitled to, which ultimately keeps more money in your business.
Okay, taxes are a big one. What else? Does it help with just, like, understanding how the business is actually doing?
Absolutely essential for that. Clear separation creates clear, accurate financial records, and those records are vital for actually managing your business effectively. How else can you reliably understand your profitability or identify which parts of the business are growing or which are struggling? How can you set realistic budgets or make informed strategic decisions if you don't have solid financial data? Separation allows you to generate meaningful financial statements like a profit and loss, P&L report, a balance sheet that give you real insights, not just guesswork based on a jumbled bank account.
And what if you need to get a loan down the road? Or maybe even sell the business one day?
Absolutely crucial for both. Lenders, investors, potential buyers, they all need to see clear, accurate, professional financial records. It's how they assess your business's financial health, its profitability, its cash flow, and, frankly, your capacity as an owner to manage money responsibly. If your financials are a mess of commingled funds, the business looks unprofessional, risky, and it's much harder to demonstrate its true value or its ability to repay a loan. Clear separation establishes a clean, verifiable paper trail for every single transaction, which is invaluable in those situations.
Okay, the why is incredibly clear. It's legally critical. It's essential for taxes, for management, for funding, for valuation. So what are the practical, actionable steps the sources recommend for actually doing this separation, especially for someone maybe just starting out or someone who admits they might have been a bit lax about it so far?
The sources are very direct here. The absolute first and most important step is this: open, separate, dedicated business bank accounts, period.
Not negotiable.
Not negotiable. This means, at minimum, a separate business checking account. Often, it's also wise to open a separate business savings account. And the rule is simple. Do not use your personal bank accounts for any business income coming in or any business expenses going out. All business money flows through the business accounts.
So customer payments go into the business account, and you pay suppliers, rent, utilities, everything for the business from the business account.
Exactly. And the same logic applies to credit. Apply for and use a dedicated business credit card, making sure it's issued in the business's name. Use this card for all business purchases.
And the flip side, don't use personal credit cards for business stuff, and definitely don't use the business credit card for personal expenses, right? Like buying groceries or movie tickets.
Absolutely not on both counts. That's classic commingling right there.
What about those situations where maybe you're out and you need to buy something small for the business and you only have your personal card? Is that okay sometimes?
Look, the sources strongly advise against making this a habit. While technically, yes, you can reimburse yourself from the business account for a legitimate business expense that you accidentally paid for personally, and you should document that reimbursement carefully. Doing it frequently just creates a messy accounting trail. It increases the risk of errors, makes bookkeeping harder, and can raise red flags in an audit. It is far, far cleaner and safer to just get in the habit of always using the business card or business account directly for business expenses.
Good discipline. Okay, what else? Pay yourself properly.
Yes. Don't just take random cash withdrawals from the business ATM or transfer chunks of money to your personal account whenever you feel like it. Establish a regular, consistent method for paying yourself.
How does that work depending on the structure?
If you're set up as a corporation, or an LLC taxed as a corporation, and you work in the business, you should generally pay yourself a reasonable salary as an employee, with proper payroll taxes withheld. If you're a member of an LLC taxed as a partnership or sole prop or a partner, you typically take owner's draws. The key is that these payments are regular, documented transactions showing money moving formally from the business to you personally, treated appropriately as compensation or distribution of profits. Avoid those random, undocumented withdrawals.
Okay, regular salary or draws. What about tracking expenses?
Implement strict expense policies within the business, even if you're the only employee. Decide clearly what qualifies as legitimate business expense and stick to it. Keep all your business expenses separate and meticulously documented.
Documentation seems like a huge piece of this.
It really is. You need to maintain detailed records of all business transactions, income coming in, expenses going out. Keep receipts, keep invoices, keep bank statements, keep credit card statements. Get them organized. The sources mentioned you could start simply maybe with physical folders for things like cash sales, accounts receivable, money owed to you, accounts payable, bills you owe. But honestly, moving quickly to a digital system is much better.
Like accounting software.
Yes, using dedicated accounting software is highly recommended, almost essential. Good software helps you track every transaction accurately, categorize income and expenses correctly, easily generate those important financial reports we talked about, P&L, balance sheet, reconcile your bank accounts, and it generally simplifies tax preparation and compliance. Plus, having accurate accounting records isn't just good practice. It's often a legal requirement for tax purposes.
And you can't just set it up and forget it, right? You need to look at it.
Absolutely. Conduct regular financial reviews, look at your reports, reconcile your bank and credit card accounts, make sure everything matches up. Doing this, ideally monthly or at least quarterly, allows you to catch any mistakes, any instances where maybe personal and business funds accidentally got mixed up, or any miscategorized transactions before they snowball into bigger problems.
Makes sense. Anything else?
One final point the sources make is to educate everyone involved. That means yourself, first and foremost, but also your family, especially if personal finances might sometimes intersect with business needs, like using a personal vehicle for business. Occasionally you need strict rules and tracking for that. And definitely any staff you have, especially anyone who handles money or makes purchases. Everyone needs to understand why this separation is so important and what the rules are. And if all this sounds overwhelming, hire a professional bookkeeper or accountant. Seriously, they can help set up your systems correctly, ensure you're following best practices, provide that objective outside perspective, and take a lot of the burden off you, allowing you to focus on running the actual business, knowing the finances are being handled properly.
That sounds like very good advice. This takes real discipline day in and day out. But the alternative, as you said, sounds like potential disaster. And the sources, they actually included a cautionary tale, didn't they? About a business called Construct Right LLC that really brings the risks of not doing this separation to life.
It really does. It's a powerful and unfortunately realistic example of just how critical this financial separation is. So the story goes, there's this guy, John, owner of Construct Right LLC. He had what seemed like a pretty successful construction business, and he had done the first step right. He formed an LLC, presumably that gave him personal liability protection.
Okay, so he had the structure.
Yeah, the structure. But his everyday habits, his financial practices, were systematically tearing down that protective shield he thought he had.
How? What was he doing wrong?
He was commingling like crazy, based on the description. He would routinely use his personal credit card to buy building materials for jobs or pay for business-related travel, just mixing those expenses right in with his personal spending.
Okay, mistake number one.
Then he'd often take cash out of the business ATM for his own personal spending money. just direct withdrawals of business funds for non-business purposes.
Mistake number 2.
He used the company truck frequently for personal errands, family vacations, you name it, without properly tracking the split between personal and business mileage, which is essential for deductions and avoiding issues.
Mistake number 3. Blurring assets.
Exactly. And maybe the kicker. He even had his construction crew perform significant renovation work on his personal home, but didn't properly account for their time or ensure the business was fairly compensated for that work. Essentially using company resources for personal benefit without clear documentation or payment.
Wow. So he was basically treating the business like it was just an extension of his personal finances and assets, his personal piggy bank, like you said earlier.
Precisely. And the sources point out that these sloppy practices had immediate negative consequences for his business's health, even before any major legal trouble hit.
Like what?
Well, as Construct Right grew, it needed more funding, maybe for bigger projects or new equipment. But Joe had found it incredibly difficult to secure bank loans. Why? Because when lenders looked at his financial statements, they were a complete mess. Personal and business transactions were all interwoven. They couldn't accurately assess the business's true cash flow, its actual profitability, or its ability to repay. The commingling made the business look disorganized and far too risky to lend to.
So the lack of financial separation directly hurt his ability to grow the business by blocking access to capital.
It absolutely did, and it got worse. When John eventually decided he wanted to sell the business, the commingled finances severely damaged its valuation.
How so?
Potential buyers, when doing their due diligence, were immediately wary. They couldn't get a clear, reliable picture of the company's historical financial performance, its true operating costs, or its real bottom-line profitability. It was impossible to cleanly separate where the business ended and John's personal spending began. This made the business look less valuable, riskier to acquire, and ultimately drove down the price he could get for it.
So his carelessness with the money directly cost him significant money when he tried to sell.
Almost certainly. Significant money. But the most devastating consequence, the real nightmare scenario, came later when Construct Right faced a major lawsuit. It was related to a construction defect claim on one of their projects.
Okay, a typical business risk for a construction company.
Right. But because John had consistently, over years, blurred the financial and operational lines between himself and his LLC through all these commingling practices we discussed.
The plaintiff's lawyers saw an opening.
They absolutely did. They argued successfully in court that Construct Right LLC wasn't truly operating as a separate legal entity. They presented all the evidence of commingling the shared accounts, the personal use of assets, paying personal bills from the business to argue that the LLC was just John's alter ego.
They argued that the corporate veil should be pierced.
Precisely. And the court agreed. The judge ruled that John had failed to maintain the necessary separation, failed to respect the corporate formalities, and had essentially treated the LLC as indistinguishable from himself. Therefore, the corporate shield, the limited liability protection he thought he had, was pierced. It was disregarded.
And the outcome for John personally?
Catastrophic.
Yeah.
When Construct Right lost the lawsuit and ended up owing a large judgment sum, that legal protection was gone. His personal assets were no longer shielded. The plaintiff who won the lawsuit was legally able to go after John's personal savings, his investments, and ultimately they could even force the sale of his personal home to satisfy the business's debt.
Oh my gosh, he lost everything.
Pretty much. The Construct Right story is just a stark, cautionary tale highlighted in the sources. It shows, in very real terms, that without diligently, consistently maintaining that financial separation, even having the right legal structure like an LLC, might not save your personal wealth when serious trouble hits your business.
That story really drives home the point. The legal structure is necessary. It's the foundation. But it's the ongoing actions, especially that strict financial separation, that actually make the shield strong and keep it intact.
It truly does. And building on that, the sources point to a couple of other important layers of defense that you should seriously consider, along with getting professional guidance, to further protect yourself and your business.
Okay, let's talk about those additional layers. Insurance definitely comes to mind as another critical piece.
Absolutely critical. Having adequate business liability insurance acts as a vital financial safety net. It protects your business's financial interests, and by doing so, indirectly helps protect your personal assets by ensuring the business can pay claims rather than collapsing from potentially devastating lawsuits and other significant claims.
How does it work? What does it cover?
Business liability insurance is primarily designed to cover the costs associated with claims against your business. This includes things like the cost of hiring lawyers for legal defense, which can be enormous, even if you ultimately win the case, any settlements you agree to pay, or jury awards if you lose a trial. It can also cover medical costs if, say, a customer slips and falls on your business property, or property damage your business might cause to others, or even claims related to things like libel, slander, or false advertising in your marketing materials.
So if the business gets sued for something covered by the policy, the insurance company steps in and pays the lawyers, and if necessary, the settlement or judgment up to the limits of the policy.
That's the basic idea, yes. The sources mention several key types of liability insurance. General liability insurance is kind of the foundational policy for most businesses. It covers those common claims for bodily injury or property damage that might occur on your premises or as a result of your operations.
Okay, basic slip and fall type stuff.
Right. Then there's professional liability insurance, which you might also hear called errors and omissions, or E&O insurance. This is absolutely vital for any business that provides professional services or advice. Think consultants, accountants, architects, IT professionals, therapists, etc. It covers claims alleging that your client suffered a financial loss because of your negligence, mistakes, errors, or things you failed to do, omissions, in providing your service.
Got it. Crucial for service providers. Any others?
Product liability insurance is essential if your business manufactures, distributes, or sells physical products. It covers claims for injury or property damage allegedly caused by a defect in those products.
Makes sense if you're selling things. Does the cost of this insurance vary a lot?
Oh, definitely. It varies hugely based on the type of business, the industry, the perceived level of risk, your claims history, the coverage limits you choose, and your location. A construction company, for example, is going to face much higher liability risks and therefore pay significantly more for general liability insurance than, say, a freelance writer working from home.
The sources also mention something called a BOP.
Yes, a business owner's policy, or BOP. This is often a cost-effective option, especially for small, lower-risk businesses. A BOP typically bundles general liability insurance together with commercial property insurance, which covers damage to your business property, like your office or equipment, into a single package policy, often at a lower premium than buying them separately. Okay, now what if a potential lawsuit could result in a really huge judgment? Something that might exceed the limits of your standard general liability or professional liability policy. That's a really important consideration, especially for businesses with higher risk exposure. That's where excess liability insurance or commercial umbrella insurance comes into play.
Umbrella insurance, like an extra layer on top.
Exactly. These policies provide an additional layer of liability coverage above and beyond the limits of your underlying primary liability policies, like your general liability, your commercial auto liability, maybe employer's liability. If a large claim exhausts the limits of your primary policy, the umbrella policy kicks in to cover the rest, up to its own, usually much higher, limit. It's a crucial safety net against catastrophic claims.
Good to know. The sources also highlighted something called D&O insurance, directors and officers.
Yes, directors and officers liability insurance, or D&O. This is a specialized type of policy designed specifically to protect the personal assets of a company's directors and officers. Why? Because even with the protection of the corporate shield, for LLCs or corporations, directors and officers can still be sued personally for alleged wrongful acts related to their management decisions, their oversight duties, breaches of fiduciary duty, and things like that. D&O insurance helps cover their personal legal defense costs and potential settlements or judgments arising from such claims.
So it protects the individuals running the company from personal lawsuits related to their roles.
Precisely. It's another important layer, especially for companies with outside directors or those seeking investment. And just to tie this back to the main theme, while liability structures like LLCs and corporations protect your personal assets from business debts and most liabilities, they don't necessarily protect the business itself from facing massive judgments that it simply cannot afford to pay.
Right. The shield protects you, but the business could still go bankrupt if hit with a huge lawsuit it can't cover.
Exactly. And if a legal judgment against your business is so large that it exceeds all the business's available assets and all of its insurance coverage, there's still a major problem. While your personal assets might still be protected by the entity structure, assuming you didn't pierce the veil, a judgment that bankrupts the business could still devastate you financially, especially if you've personally guaranteed some business debts or if the business is your primary source of income.
So having enough insurance coverage really scaled appropriately to your business's specific risks is a critical part of the overall defense strategy, not just for the business, but indirectly for you too.
Absolutely. It's not just about ticking the box that says I have insurance. It's about having adequate coverage limits.
The sources also briefly mentioned trusts as another potential tool.
Yes, they touched on trusts as a legal tool that can sometimes be used as part of a broader, more advanced asset protection strategy. The idea is that certain types of trusts can potentially hold your personal assets in a way that might shield them from creditors, including potentially claims that might somehow get past an LLC or corporate shield, or claims unrelated to the business altogether. Trusts are complex legal instruments, though, and setting them up properly requires specialized legal advice. They're not a simple fix, but they can be part of a comprehensive personal asset protection plan for individuals with significant wealth to protect.
Okay. And speaking of specialized advice, that seems to be a constant refrain throughout all these sources, the absolute necessity of getting professional help to navigate all of this complexity.
It really is presented as pretty much non-negotiable for doing this right. Trying to figure out the absolute best business structure for your unique situation. Trying to draft legally sound operating agreements or corporate bylaws yourself, setting up bulletproof accounting systems, ensuring you meet all the ongoing state and federal compliance rules, fully understanding the tax implications of every choice, and navigating all the potential pitfalls like commingling funds perfectly on your own. Well, it's incredibly challenging and, frankly, very risky.
Too easy to make a mistake that costs you dearly later.
Exactly. That's where professionals come in. Business counselors, experienced attorneys who specialize in business formation, corporate law, and liability issues, knowledgeable accountants or CPAs, and qualified financial advisors, they all possess specific expertise that is vital to this entire process.
Can you break down how each of them helps with the specific issues we've been discussing?
Sure. A good business attorney is invaluable right at the start. They can help you evaluate the pros and cons of each legal structure. Sole prop, partnership, LLC, C Corp, S Corp election, based on your specific business activities, your ownership structure, your risk tolerance, and your future plans. They can then draft a really solid customized operating agreement for your LLC or help with the corporate bylaws and initial board minutes for a corporation, ensuring these foundational documents are legally sound, tailored to your needs, and provide the strongest possible legal shield under your state's laws.
Okay, legal setup covered. What about the money side?
That's where your accountant or CPA is absolutely essential. They can help you set up your chart of accounts and implement proper business accounting systems right from the beginning. They are key to ensuring you maintain that strict financial separation we hammered home, advising on best practices for bookkeeping, expense tracking, and avoiding commingling. They can explain the tax implications of the different structures and help you decide on the best tax treatment, like that S Corp election. They advise on how to properly handle owner compensation, salary versus draws. And crucially, they ensure ongoing tax compliance filing returns correctly and on time.
And a financial advisor, how do they fit in?
A financial advisor can help you look at the bigger picture, integrating your personal financial planning with your business strategy. They can help you understand how the business affects your overall personal wealth goals, the role that adequate insurance, both business and personal, plays, and potentially discuss more advanced asset protection strategies, maybe involving things like trusts within the context of your complete financial situation.
So they all bring that unbiased, expert perspective and specialized knowledge that most of us business owners just don't have on our own.
Precisely. Their guidance is invaluable for making informed decisions up front, for minimizing your personal liability risk ongoing, for ensuring you meet all the compliance requirements, which avoids penalties and protects your entity's good standing, and ultimately for building a solid, well-protected foundation for your business to succeed. Honestly, investing in good professional advice at the beginning and along the way can save you exponentially more time, money, and agonizing stress down the line by helping you avoid those potentially catastrophic mistakes, like picking the wrong structure, failing to maintain formalities, or maybe most critically, accidentally commingling funds in a way that destroys the very protection you sought in the first place.
Okay. So bringing this all together then, protecting your personal assets when you're running a business in the U.S., it's definitely not about finding one single magic bullet solution. It's really a multi-layered strategy drawing on everything these sources covered.
That's a perfect way to summarize it.
You start by choosing the right legal structure, LLC, corporation, maybe a specific type of partnership that provides that initial shield. But then you realize that shield is only going to be effective if you actively bolster it with those essential legal documents like operating agreements or corporate minutes. And crucially, if you maintain absolute discipline in keeping business and personal finances strictly separate. Then you add on other layers of protection, like making sure you have adequate insurance coverage tailored to your risks. And you lean on professional advice from lawyers, accountants, and advisors to make sure you're doing it all correctly. You put all those pieces together, and that's how you build a truly robust defense against business risks threatening your personal life.
Yes, I think the core strategies distilled from all these sources are pretty clear and, importantly, actionable. If we were to list them out, it would be something like:
make a really informed decision about your business structure. Sole prop, partnership, LLC, corporation, fully understanding the personal liability implications of each. And for most people who have personal assets they need to protect, that usually means starting with an LLC or a corporation.
Right. Structure first.
Number 2, put in place and then meticulously maintain those crucial legal documents and formalities. That means a robust, well-drafted operating agreement for an LLC. It means proper corporate minutes and adherence to meeting requirements for a corporation. And for both, it means always appointing and maintaining a reliable registered agent in your state. These things prove your business is a separate entity and help prevent that veil from being pierced.
Okay. Documents and formalities second.
Number 3, implement and rigorously enforce strict financial separation between your business and personal funds. This is just non-negotiable. Use separate bank accounts, separate credit cards, proper accounting systems. Pay yourself via a clear salary or documented draws. Document everything. Commingling is probably the single fastest way to lose your liability shield.
Financial separation is number 3, and it sounds like maybe the most critical ongoing action.
It very well might be. Number 4, augment your protection with adequate layers of defense. This includes carrying sufficient business liability insurance, general liability, professional liability, product liability, whatever fits your risks, and considering things like umbrella insurance for catastrophic claims or D&O insurance if you have directors and officers, and potentially exploring more advanced tools like trusts, but only with professional guidance.
Insurance and other defenses, number 4.
And finally, number 5. Do not hesitate to seek out and pay for expert professional advice. Talk to business lawyers, talk to accountants, talk to financial advisors. Their expertise is absolutely critical for setting things up correctly in the first place, ensuring you stay compliant over time, navigating complex issues as they arise, and helping you avoid those potentially devastating areas that could put your personal assets at risk.
Structure, documents, separation, defenses, advice. Got it. And it's clear this isn't just about the day you incorporate or form the LLC. It's about the ongoing discipline and the processes you consistently maintain throughout the entire life of the business.
Absolutely. Which I think leads us perfectly into our final thought for you, the listener, to really ponder as we wrap up this deep dive. Given everything we've just unpacked, the reality of personal liability, the different types of shields available, the specific documents and practices needed to make those shields actually work, and the very real dangers, like piercing the corporate veil if you get sloppy, how confident are you feeling, like right now, that your personal assets are truly and securely protected from potential problems in your business?
That's a really good question to sit with. And maybe thinking about your own current business, or perhaps your plans for a future business, based on everything we've discussed today from these sources. What is just one specific action, maybe even a small manageable step, that you could commit to taking this week to either strengthen that financial boundary you have, or maybe just to get a clearer picture of your current level of protection?
Yeah, whether that one step is maybe doing some research online about professional registered agent services in your state, or finally scheduling that appointment to go open a dedicated business bank account you've been putting off, or even just making a list of specific questions you now have for an accountant or a lawyer. Taking that single concrete action based on this knowledge is probably the most important next step you can take towards securing that peace of mind.